Have you ever experienced the heartbreak of winning 5 trades in a row, only for one single losing trade to completely wipe out all of your hard work? You spend days carefully studying the charts, making small, steady profits, feeling like you're finally starting to understand trading. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. But then, you take one bad trade, and because your stop loss is so massive, it instantly drains your entire week's worth of profits. It feels incredibly discouraging, like you are taking 1 step forward and 2 steps backward. This happens because your trading math is completely broken. When you enter a trade with a giant stop loss, your profit target must also be giant just to make a small return. You are risking $100 just to make $50 or $80. To survive in the long run, you do not need to win every single trade. Instead, you need sniper entries. A sniper entry allows you to enter the market at the absolute turning point of a move, keeping your stop loss incredibly small and your profit potential massive. In this masterclass, I'm going to show you exactly how to get these sniper entries using simple, beginner-friendly techniques. We will skip the complicated theories and focus purely on 3 clean steps: understanding cheap and expensive zones, zooming in with multi-timeframe analysis, and using the 2-step rule to prevent over-refining your charts. This simple system will completely transform your risk-to-reward ratios. Please hit the like button, subscribe, and let's get started. Part 1. Understanding cheap floors and expensive ceilings, supply and demand. Before we can refine our entries, you must first master the basics of where the big market players are waiting to buy and sell. In trading, we call these areas supply zones and demand zones. Let's explain this using a simple real-world shopping analogy. Imagine you want to buy a brand new smartphone. If the store suddenly announces a 50% discount, that price level represents a massive bargain. Buyers will rush to the store, creating high demand. On our trading chart, this cheap floor is what we call a demand zone. It is an area on the chart where the price rested sideways for a brief moment before launching into a powerful, aggressive upward move. To draw this zone, we simply find the very last resting candle right before that big upward sprint began, and we draw a horizontal box around it. This box represents our discount zone, where we want to wait patiently to buy in the future. Conversely, imagine you own a rare, luxury collectible item. If the market price of that item suddenly skyrockets to a massive premium, you will want to sell it immediately to lock in your profits. On your chart, this expensive ceiling is what we call a supply zone. It is the area where the price rested sideways before launching into a violent downward drop. We draw a box around the last resting candle before that drop, representing our premium zone, where we wait to sell. Part 2. The magic of zooming in zone refinement secret. Now that you know how to draw these basic zones, let's talk about the real magic: zone refinement. If you only trade using large timeframes, like the 4-hour chart, your drawn supply or demand boxes will be very wide. If you place your stop loss outside a wide 4-hour box, your stop loss has to be massive. This means your profit potential is very small. For example, you might risk $100 just to make $190, which is a poor 1.9 risk-to-reward ratio. To fix this, we use multi-timeframe analysis to zoom in on that wide box, just like adjusting a camera lens to see a blurry object clearly. Let's say we drew a wide supply box on the 4-hour time frame. Instead of trading it blindly, we switch our chart down to the 1-hour time frame. When we look inside that same 4-hour box on the 1-hour chart, we will notice that the actual downward sprint started from a much smaller, tighter resting candle at the very top. By drawing our new box around this smaller one, our zone, we have refined our entry. This allows us to place our pending sell order higher up and keep our stop loss incredibly narrow, right above the small one, our wick. Look at the incredible math. By refining the zone, we turn that same exact trade with the same profit target from a 1.9 ratio into a massive 6.25 risk-to-reward ratio. You are now risking $100 to make $625. Part 3. The extreme versus confirmation entry dilemma. When we zoom into a lower time frame, we will often find multiple smaller zones inside our larger time frame box. This brings us to a major question that confuses many beginners. How do I choose which zone to trade from? You have two primary options: the extreme zone or the confirmation entry. Let's break down both so you can choose the style that fits you best. The extreme zone is the very top zone in a supply leg, or the very bottom zone in a demand leg. It is the absolute furthest price point before the market reversed. Placing a pending limit order at the extreme zone is the safest set and forget method because it gives you the highest possible payout and the tightest stop loss. However, the downside is that sometimes the price will reverse early from the first zone, and you will miss the trade entirely. If you want to avoid missing trades, you can use a confirmation entry at the first zone. Instead of placing a blind limit order, you wait for the price to touch the first zone on the lower time frame. Then, you watch the candle structure. If you see the lower time frame structure shift, meaning it fails to make a new high and instead breaks a low, you enter the trade manually. This confirms that the zone is active, reducing your chance of missing the move. Part 4. The dangers of over-refinement, the two-step rule. Now, let's discuss an incredibly critical warning for beginners: the danger of over-refinement. When new traders learn about zone refinement, they get greedy. They think if refining from 4 hour to 1 hour is good, then refining from 1 hour down to the 1 minute chart must be even better. I will have a stop loss of just 1 pip and make $1 million. This is a highly dangerous trap. When you zoom in too far, you are looking through a microscope at a grain of sand, and you completely lose sight of the ocean. The 1 minute chart is filled with massive market noise, random algorithmic spikes, and spread fluctuations. If your stop loss is too tight, you will get stopped out by normal market breathing before the price actually moves in your direction. To prevent this, you must follow the two-step rule. The two-step rule is very simple. Never refine your zone more than 2 time frames below your starting analysis chart. Let's look at the standard combinations. If you find your zone on the 4 hour chart, you can refine it to the 1 hour chart and at most down to the 30 minute chart. Do not go any lower. If you start on the daily chart, you refine to the 4 hour and at most down to the 1 hour. This ensures you get a sniper entry while still keeping your stop loss safe from random market noise. The road to consistent success. Refining your zones using the multi-timeframe two-step rule is the ultimate way to secure sniper entries, reduce your risk, and skyrocket your profitability. If you want a complete, free, step-by-step system on how to build a professional trading plan, please check out the link in the description below. Thank you so much for watching. Please hit the like button, subscribe to the channel, and we will see you in our next trading masterclass. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.